Hi, welcome to another video. In case you didn't know from watching any of my previous videos, I'm a graduate of business school, a finance major. I'll let you in on something. Personal finance is not taught in business school, and so I've had to teach myself this stuff, but I'm happy to share my journey and my learnings with you. And so in this video, I'll share with you 5 ratios that if you're looking to invest in the stock market are good to know and will be very helpful on your journey. And if you stay to the end, I'll throw in one bonus. Now, right off the top, please do not get intimidated by the word ratios. These numbers are readily available on financial websites. You've got this. Just stick with me and you'll see how easy this is. The general recommendation is that if you do not trust your stock picking skills, you should stick with index funds or ETFs, or if you're new to investing. Now, the advantage of investing in index funds and ETFs is that because they are a bundle of stocks, they come highly diversified, and this helps you manage the volatility in the stock market. The other advantage of investing in index funds and ETFs is that they are put together by professionals in these large brokerages and financial institutions like BlackRock, Vanguard, Schwab, and so on. And so you will have comfort investing in the stock market even if you do not have the qualifications required to pick stocks because somebody else has done all the dirty work for you. There are index funds and ETFs that are focused on specific sectors like technology or utilities or financials, focused on different regions like Asia or developing economies and so on. There is no limitation of investing in index funds or ETFs. So that's the beauty of starting by investing in index funds or ETFs. Now, having sung the praises of index funds and ETFs, I've been investing for myself since about the end of 2021. And over this period, I have learned that a lot of investors, including myself, will eventually gravitate towards individual stocks as we become more comfortable. At the end of this video, you'll find your confidence has gone up a little bit because you have a better understanding by looking at these numbers. Again, you'll probably never have to calculate these numbers as they are readily available for free on one of the many free resources, financial resources online. Think Yahoo Finance, Seeking Alpha, Morningstar, or wherever else you get your financial information from. Now, before we get to the ratios, here is the first and most logical step in researching a stock to invest in. Start by considering investing in a company that you understand. Companies like Procter & Gamble, whose products are available in a lot of homes, from laundry detergents like Tide and Bounce, Dawn, Oral-B, Pampers, and so on. Or Johnson & Johnson, a company in the healthcare sector. Most of us use Johnson & Johnson products on a daily basis. Medication like Tylenol, Motrin, or Band-Aid are made by Johnson & Johnson. Coca-Cola, Apple. There is an endless list of companies whose products and services we use on a daily basis. Those would be the perfect place to start doing your research because you'll have some confidence in knowing what they do. And so you can tell whether or not they have ongoing demand for their products and services. And that would be the first step in deciding whether they are a good business or not. Now, as always, this video is meant for education and entertainment purposes only. It is not financial or investment advice. Now, let's look at the numbers. The first ratio is the price to earnings ratio, or simply the PE ratio. The PE ratio helps you determine how cheap or expensive the price of a stock is. The PE ratio of a stock is simply the price per share of a company divided by the earnings per share of that company. Generally, a high PE ratio may be an indication that the stock price of a company is high relative to its earnings, and so the stock price may be overvalued. And the reverse is true. A low PE ratio may indicate that the stock price is low compared to the earnings of the company, and so now might be a good time to buy. Now, in isolation, the PE ratio of a stock does not say much. You cannot tell whether it's high or low. In order to determine whether the PE ratio of a stock is high or low, you'll need to compare it against the PE ratio of other similar stocks in the same sector or industry. Here, let's look at some PE ratios of a few companies in the tech space and you'll see what I mean. Okay, so in this chart, you can see there are about 7-8 companies, Alphabet, Meta, Microsoft, and so on. You can see that the PE ratio for Google is 20.25, Meta is 24.39. Look at Palantir. It has a PE ratio of 453. Now that is high. It means that the share price of Palantir is significantly overvalued relative to the earnings that you'd get from investing in this stock. In the table, you will see that Google has the lowest PE ratio of 20.25. And so it may be that relative to all other companies in the tech space at this time, Google is the most fairly priced or undervalued. And so it might be a good stock to invest in. And this is how you use the PE ratio to decide whether or not to invest in a stock. Now, if you enjoy content like this, please consider liking this video and subscribing to my channel. It helps the channel grow so I can reach more people. The second ratio is the payout ratio. This ratio helps you determine the dividend sustainability or the dividend growth of a stock. It is the dividend amount as a percentage of a company's earnings. Here's an example. If a company earns $2 per share in profits or net income and pays out $1 in dividends, then the payout ratio is 50%. The lower the payout ratio, the more sustainable a dividend is. A good rule of thumb is that a payout ratio of 60% or less is great. However, you want to consider this in relation to other factors, like the overall sector payout ratio. Now, a payout ratio of over 100% simply means a company is having to resort to borrowing to keep on paying dividends, which is a red flag in itself. That being said, if you're interested in a company and all the other numbers seem good, it's worth exploring in details why a company has a high payout ratio of over 100%. Here's an example. I invest in a company called Enbridge with a lot of infrastructure, pipelines all over North America. It has a high payout ratio of more than 150%. However, I also know that Enbridge is a regulated company and has a lot of long-term contracts with governments both in Canada and the US. So I'm comfortable investing in Enbridge, even with a high payout ratio, because I know they have guaranteed revenue long into the future, decades ahead, because of these long-term contracts that they have with governments both in Canada and the US. The third ratio is the dividend yield. It tells you how much passive income in the form of dividends or interest you can expect to receive from your investment or stock. A yield is simply a return on investment expressed as a percentage. Now, when it comes to stocks, a dividend yield is simply the total share of a company's profits or earnings that is returned to its shareholders. It's usually calculated on a yearly basis, even if it's generally paid on a quarterly or monthly basis. So about 4 times a year or monthly. REITs, real estate investment trusts, tend to pay their distributions on a monthly basis. Here is an example. If a company paid 60 cents in dividends in one quarter, and we assume that dividend payments will remain consistent over the next 3 quarters, then in total it will pay $2.40 in dividends for the year. Now let's assume that the stock price of this company is $75 per share. To get to the dividend yield, you simply divide the $2.40, the amount of dividends paid per year, by the stock price of $75 and multiply by 100, and voila, you have the dividend yield. Something to note is that a high dividend yield is not always a good thing, because a high dividend yield may just be a sign of poor financial health or a declining stock price of a company, known as a yield trap. A yield trap is when a stock's dividend appears attractively high and usually high above industry average or above historical norms. Here is an example. Let's look at a company. Let's look at Vodafone. Vodafone is a US giant telecom company, and it has a declining stock price. And as we see here, it currently has a really high yield of 7.4%. However, you can see it has a stock price of less than $10. If we look at the last 5 years, you can see that the stock price has declined by about 23%. If you look at its all-time high, you can see that its stock price has come from as high as $66, and yet it has a high dividend yield. And so stocks like these are called yield traps. Now, as a dividend investor, I tend to prefer investing in companies with a dividend yield of between 1 to 4%. Granted, I have some few that have a higher yield, But my focus is usually not just on yields today, but also growth in dividend income in the future. And so I tend to focus on large blue chip stocks like, Procter & Gamble, Johnson & Johnson, TD Bank, Apple, AbbVie, companies that have a good record for good, stable dividend payments. They're usually not great with growth, but I'm a dividend investor. I'm looking for income and cash flow, not necessarily growth. Most of my stocks are dividend stocks. I only have one stock in my portfolio that does not pay dividends. The next ratio is the management expense ratio, or simply the expense ratio. The expense ratio will tell you what it will cost you to invest in a stock, an index fund, or an exchange traded fund, an ETF. In order to minimize the cost of investing in a stock, consider investing in an index fund or an ETF. Because while mutual funds, the kind of investments your money is put in when you go into your bank and say, I want to invest in the stock market, those are actively managed stocks. Mutual funds are actively managed, so they tend to have a higher expense ratio compared to index funds and ETFs that are based on a fixed formula because they track specific indices like the Dow Jones, the Nasdaq, the S&P 500, the FTSE, the TSX, the Russell 2000. Usually, the description of an index fund or ETF will tell you what index it tracks. So there are a lot of great stocks, there are a lot of great ETFs or index funds that cost just pennies to the dollar to invest in. ETFs like VOO, SPLG, or XIC, they cost about 0.03 or 0.06% to invest in some of these ETFs. I found a quick expense ratio calculator online, and you can do the same to decide whether the cost of investing in a stock with a certain ratio is worth it. Here is an example. If you went to the bank and said, I wanted to invest in the stock market, and your money is put in a mutual fund and it has an expense ratio of 1.75, let's look at what it would look like. If the initial investment was, say, $10,000, and then you continued to contribute to it $300 per month, and so that would be $3,600 for the year. And let's say you expected a return of 10%, which is the average return of the S&P 500, and you left the money in this investment for 25 years. At the end of 25 years, you'd have $345,550. Now, if you put this same investment in an index fund or an ETF with 0.06%, you started with $10,000 again and contributed $300 per month, so $3,600 per year, and expected return again, 10%, and you invested for 25 years, you'd end up with $457,750. The difference between these two investments based on the expense ratio is over $112,000. So by investing in a mutual fund with an MER or expense ratio of 1.75%, you lose more than $112,000. That's why it's important to know what the cost of investing in any given stock is if you want to build wealth and keep most of the gains in your portfolio to yourself. Last but not least, free cash flow. Free cash flow is the cash a company has on hand to meet its short-term obligations as they come due: interest on debt, dividend payments, operational expenses. If a company does not have adequate free cash flow to meet its short-term obligations, that's a red flag right there. Let's look at one. Looking at Procter & Gamble, for instance, P&G, so this is on Yahoo Finance. If you go under financials, and you scroll to cash flow, if you come down here, you'll see the free cash flow is here. So what this means is that Procter & Gamble has more than $15 billion sitting in liquidity in its books in the TTM over the last 12 months. So this should give you confidence in investing in a company like this. So the free cash flow of any company speaks volumes about its financial health. A company that is not able to meet its short-term financial obligations as they come due, it's not able to pay dividends or pay interest on its debt to service its debt and meet other operational needs, is a clear red flag. Unless, of course, you've dug deeper and found a reason for why it has very low cash flow. I told you earlier that I invest in Enbridge, even if I know it has a high payout ratio of more than 100%. because I'm comfortable that Enbridge will continue to receive revenue from its many long-term contracts that it has with governments both in Canada and in the US. If the only red flag you have of these 5 ratios is one, dig deeper and find out why. It might be something you can live with, and so you don't miss out on investing in a good stock. So those are the 5 key numbers that any investor looking to invest in individual stocks should have some kind of understanding of. The PE ratio, the payout ratio, the dividend yield, especially for dividend investors, the expense ratio, the free cash flow. And if all these seem to point in the right direction, then you can do some other fundamental analysis before you put money into any stock. Now, for the bonus, market capitalization. Because I'm a dividend investor, I tend to like to invest in large, well-established companies that are dependable dividend payers. Procter & Gamble, Coca-Cola, Apple, and so on. They're not growing rapidly anymore, but they are stable, dependable dividend payers. Generally, large cap stocks tend to grow slowly compared to mid-cap stocks. Mid-cap stocks are companies with a capitalization of between $2 billion and $10 billion, and small-cap stocks, which tend to be having a lot more room for growth, have a market cap of between $250 million and $2 billion. While technically a company with $10 billion is a large cap company, I tend to seek out companies with a market cap of at least $100 billion to invest in as a dividend investor, because for me, a company with over $100 billion signifies stability, and it gives me some kind of comfort in terms of continuing dividend payments, dividend sustainability. They tend not to be big growth companies, but they do have components of growth. Think Procter & Gamble, Johnson & Johnson, Coca-Cola, TD Bank, the Royal Bank of Canada, AbbVie, and so on. So anyway, I hope you enjoyed the video and found it helpful. If you did, please consider liking and subscribing. Thank you for watching.